In this video, we're continuing our strategy blueprint series where we explore how different trader tribes can use seasonality as a practical edge in their decision making. And today we're focusing on crypto traders. Now, crypto traders are often attracted by the volatility and large price swings. They frequently combine technical analysis with macro themes, sentiment, and on-chain data to build trading opportunities. Now, unlike traditional markets, crypto is heavily influenced by liquidity cycles, risk appetite, halving cycles, regulatory developments, and surges in retail participation. And by market capitalization, the two largest cryptocurrencies are Bitcoin and Ethereum. Now, this makes seasonality especially valuable because it helps traders identify recurring tendencies within what can often appear to be chaotic price action. And the first major layer to look at is annual seasonality. Even in crypto, certain periods of the year repeatedly show stronger or weaker tendencies. For example, Bitcoin, over the last 10 years, has shown stronger performance during particular parts of the calendar year. Historically, you can see April, July, October have often been stronger months for Bitcoins. The fourth quarter has also frequently been associated with stronger directional moves. You can see here from October the 1st through to 31st of December, there's been an average return of over 25% for that fourth quarter. Now, on the other hand, there's also periods where price action has tended to be much slower and less directional. Using Seasonax's annual seasonality tools, crypto traders can identify historically strong accumulation periods, weaker seasonal windows where rallies may struggle. You can see here from August the 1st through to October the 1st. Look, there's an average return here of negative 0.060%. So this does help traders to develop, a broader directional bias before looking for individual trade setups. Now, if we move across to Ethereum, we see that the first half of the year, from January through to the end of May, has historically been a very strong period for Ethereum. You can see here from Jan the 1st through to 30th of May, been an average of 63.85%. But one thing we do notice, and that's important when working with seasonal data, is understanding whether a particular result is distorting the results. This 2017 year is a big outlier, and one of the useful features within Seasonax is the ability to filter individual years in or out the data set. So if we remove the outlier year, 2017, we see the average return is still at a healthy 19.35%, and we can see that still Ethereum is still performing well in the first half of the year, with a particular strength from the end of March through to early May, with an average return of 22%. So this demonstrates an important point. Seasonality is not about finding certainty, it's about identifying periods where the probabilities have historically been more favorable. You can see again here in Ethereum from the start of August through to early October, you can see there's an average return of negative 11.14%. So despite trading 24 hours a day and 7 days a week, crypto markets still exhibit monthly behavioral patterns that are influenced by portfolio rebalancing, stablecoin inflows and outflows, institutional positioning cycles, and broader market liquidity conditions. And by studying these tendencies, crypto traders can gain a better understanding of when buying pressure or selling pressure has historically emerged during a calendar month. And we can use intra-month seasonality to help time positioning. You can see here over the last 10 years for Ethereum, you can see that the end of the month has tended to be a relatively strong period, an average return of 1.34%. and so has the start of the month tended to be a relatively strong period of time. You can just see that here going for those first few days of the month. Again, an average return of around 1.39% and a flatter return in the middle of the month with an average return of just positive 0.24%. So the other layer that crypto traders can use Seasonax for is risk management. Many traders will use seasonality to identify potential opportunities, but it is a very valuable tool for managing risk. And one particular valuable tool is you can look historically and see the size of adverse moves that have occurred in the past. So for instance, in previous years, you want to look at this summer month, you can see, well, how far are those falls? You can see the maximum adverse falls have been about 20% in the summer month for Bitcoin. And that could tell you, okay, if we get a fall of about 20%, that's towards the maximum adverse excursion that we've had in that seasonal pattern. And that could provide a great seasonal dip buying opportunity with an average return of around 30% from the 29th of September through to the 28th of December. You can see some of those maximum gains have been really phenomenal, over 100% on 2 occasions and over 50% on 1, 2, 3, 4, 5, 6 occasions. So you can see here that by understanding historical drawdowns, that can help with stop placement, position sizing, and helping to set realistic expectations for trade performance. Rather than simply focusing on potential reward, traders can assess the risk profile of a seasonal setup before committing capital. So if you are trading crypto, I would encourage you to explore these patterns in Seasonax, and you can begin building your very own seasonal framework.